In Canadian real estate, sometimes the quiet moments tell the biggest stories. The frantic bidding wars have vanished, homes are sitting on the market longer, and buyers are hesitating even as prices start to dip. This isn't a sign of a crash, nor is it a rebound. It's the sound of Canada's housing market holding its breath. So what's really happening? New national data paints a picture of a market in transition. Across the board, home prices have declined year over year, but not all properties are affected equally. Condos have seen the steepest drops, while detached homes are experiencing a much softer landing. But here's where it gets interesting. While major hubs like Toronto and Vancouver are definitely cooling off, some smaller and mid-sized cities are bucking the trend. Places like Regina, Winnipeg, and Montreal actually saw modest price gains in 2025. It is a powerful reminder that Canada isn't one single real estate market, but dozens of unique local ecosystems. As economists peer into 2026, the forecast is clear. Expect more of this quiet recalibration. Housing activity will likely stay subdued, and any recovery will be gradual, not dramatic. The biggest story will continue to be affordability, which is shaping every decision buyers and sellers make. Let's break down the national numbers. Condominiums have taken the biggest hit, with average prices falling by about 5% year over year. Why? A few reasons. Investors are pulling back. A wave of newly completed units has increased supply, and even at lower prices, high interest rates are making it tough for first-time buyers. Townhomes and semi-detached properties are also seeing some price softness, but it's less severe. These homes are in a middle ground, attracting families who are priced out of detached houses but are still feeling the squeeze of higher mortgage rates. Meanwhile, detached homes, the traditional cornerstone of Canadian housing wealth, have proven to be the most resilient. Yes, prices are a little softer, but the declines are minor compared to condos. A persistent lack of supply, especially in well-established urban neighborhoods, continues to prop up their value. Now, let's zoom into the regional stories because that's where the real divergence is happening. Toronto and Vancouver, our two most expensive markets, are leading the correction. In Toronto, we're seeing a mix of affordability exhaustion and investor retreat. Condos, which once drove the city's growth, are now struggling with high inventory levels. The high cost of borrowing has made speculative buying far less appealing, and regular buyers are waiting for clearer signals on interest rates before making a move. Vancouver's story is similar. Despite a chronic housing shortage, demand has cooled significantly. High borrowing costs and a drop in international buyer activity have created a market that feels much slower and more negotiable than it has in years. But it's important to stress, neither city is crashing. Instead, they are in what is called a price discovery phase, a slow process where buyers and sellers gradually adjust their expectations to meet the new reality. While the big cities slow down, markets like Regina, Winnipeg, and especially Montreal are showing incredible resilience. Their secret? A combination of relative affordability, stable local economies, and lower entry costs that attract buyers moving from more expensive regions. Even with today's interest rates, the monthly cost of owning a home in these cities is often still manageable. Montreal, in particular, has benefited from strong population growth and a diverse job market, helping it avoid the sharper corrections seen elsewhere. The condo market slump is no accident. For the last decade, condos were a magnet for investor cash. Low interest rates made them easy to carry, and price appreciation felt like a sure thing. Well, that party is over. Today, investors are facing a triple whammy: higher mortgage payments, rising condo fees, and slower rent growth. At the same time, even with discounted prices, many potential owner-occupiers find that the high monthly costs just don't add up. The result is a simple case of supply outpacing demand, pushing prices down. Until interest rates ease up or wages catch up, condos will likely remain the weakest link in the housing market. Looking ahead, economists seem to agree on 3 key points for 2026. First, housing activity will stay quiet. Sales might tick up slightly, but we're not going back to the frenzy of the past few years. Second, any recovery will be modest and uneven. Markets with strong fundamentals, like job growth and affordability, will do better than those that are over-leveraged. And third, affordability will remain the central challenge. Prices are still historically high compared to incomes, meaning more people will be renting for longer or moving to find a home they can afford. It's easy to look at all this and think the market is broken. But a better word is resetting. The excesses fueled by ultra-low interest rates are unwinding. Prices are adjusting to reflect what people can actually afford. For first-time buyers, this brings new opportunities. For homeowners, it demands a dose of realism. Canada's housing market in 2026 won't be about dramatic headlines. There will be no nationwide crash and no sudden boom. Instead, it will be a story of slow movement, regional differences, and cautious optimism. The frenzy is over. The fundamentals are back. And in a country where housing has often been seen as a shortcut to wealth, this quieter, more deliberate chapter might just be the healthiest one yet. Thanks for watching, and don't forget to subscribe for more insights on the Canadian housing market.